3 seconds. So,
All right.
3, 2, 1. Welcome to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to exit highly appreciated assets such as cryptocurrency, businesses, save a failed 1031 exchange, all so you can create and preserve more wealth. Hey, I'm your host, Brett Swarts. In each episode, I'm joined by some of the best real estate, financial, and wealth advisors in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. We're also streaming on expert CRE secrets as well. Hey, I'm excited about our next guest. He's out of the great state of Minnesota. And I say that with a little accent there because I got some friends in Minnesota. And he and his group, they specialize in the gray areas of financial planning, where most advisors say they can't or won't help. They dive in. They focus in on tax side of investing and helping people learn how to spend their money. And the specialties are financial planning, business planning, implementation, business development for startup and new businesses, and so much more. Please welcome to the show with me, Brad Gotto. Hey, Brad, how you doing?
I'm good, man. How are you?
Hey, I'm doing so well. Thank you so much for asking. For our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Oh, my story, man. How long is this podcast supposed to be? I've been in this industry for 15 years. So we started with a big box firm, went independent in 2009. Been rocking the independent world ever since. And probably 3 years ago, decided that we were going to more focus in on the tax side of financial planning, because we were kind of sick of sending our clients off to CPAs to get tax advice and having the CPA go file their taxes and work backwards, but not have a plan to go forwards. And as I was taught at the big box firm, we always told our clients we can't give tax advice. And I always just thought that was funny, because if I tell a client to put $1 in an IRA, there's a tax impact. If I tell them to put it in a Roth IRA, it's the opposite tax impact. And so we just decided to dive into the tax code and make sure that as we worked with our families that we serve, that taxes were an important part of their overall life, right? Taxes and healthcare are the two biggest expenses for that kind of boomer segment of the population that we tend to work with. So I guess that's it, man. I'm married. I got a couple kids. I got a dog. I don't have the white picket fence, but.
Most important question. What kind of dog do you have?
I have an English cream golden retriever.
Ooh, English cream. That sounds.
He's white.
He's white. Okay, so you get a white.
He's white. And his name is Kinnick. And if you're a really good sports fan, you'll figure out by that name I did not grow up in the state of Minnesota.
Okay, very cool. Fantastic. Absolutely love that. I love how you said most CPAs work backwards, and you guys like to prepare and move forward and pre-plan. And you're absolutely right. I couldn't agree with you more. You know, the professional who's helping the high net worth individual, it's more and more about tax flow than it is even about cash flow, right? I mean, it's always both, and it's always been both. But the way things are moving, the way we're at here with over $29 trillion of debt and growing, the government is looking for ways to raise taxes, and they're going to give legal loopholes for us to work through these things to incentivize the economy and grow everything else, right? But we've got to know about it. We got to pre-plan, and we've got to take advantage of it before. So we're going to dive into all of those things of tax flow versus cash flow. But before we go there, Brad, before we geek out on some taxes here with our audience, I want to take one other step back. You know, I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. Some people call them strengths. Some people call them superpowers. I'm curious, what are those one or two gifts that you believe you were given, and how does it help how you help and bless people today?
Well, if one of them was humility, you've just screwed that one up, because now you're going to make me talk about myself. It's not one of them. Education. I think that I love educating people, whether it's, we get paid to do it or don't get paid to do it. My actual college degree is in ministry. Thought I was going to be kind of in education the rest of my life and in a religious capacity, and ended up in this field. And so that desire to educate people to live their best life, I think is a superpower of mine. And outside of that, it's just, I have a motor, type A, I got an ego. And when you can harness that, and I don't always, but I have a wonderful bride that helps me do it. I got a great business partner that helps me do it. You can get to some pretty powerful outcomes for people. Hence our diving into the tax code. Because to be honest with you, 3-4 years ago, I knew about as much about a 1040 or a tax strategy as average Joe lunch bucket down the street. And so what we know and what we do now is just built out of necessity as we felt for our clients. So
Beautiful. Absolutely. We're going to be in good company here. So let's dive into the number one secret to helping your clients, right? Think differently about spending money and taxes. And so what's the number one secret to, creating like a forward thinking tax flow money spending plan?
I think I could answer that a lot of ways, but I think the most practical way to answer that question is that the only way to get out of the bill is to commit a felony. And so as long as the client understands that it's not about, ridding yourself of taxes, but minimizing them, that's the first real thing that people I believe need to understand is like, look, we can try to minimize their impact, but at the end of the day, the law is the law. My job isn't to abate the law. My job is to weave you through the tax code in the most efficient way possible. Sometimes that means that we're purposely bringing taxes into your life now so that we don't have to have them later. And other times that means we are not only putting legal structures in place for generational type tax planning, but we're purposely kicking the can down the road. Both of them can make sense. It just depends on what your situation is.
Got it. So the first secret is making sure you're staying legal, right? You're not going outside the bounds, but you're using every available tax deferral or a minimization or perhaps just paying taxes if they're a little bit lower now, if it makes sense, or you have maybe some harvesting to be able to do, right?
Yeah.
Is that a fair summary so far?
Yeah, absolutely.
Okay, excellent. And so number two, what's the next secret or step, or how are you guys aiding and helping future clients to do this?
I think two things. One, building out kind of a lifetime tax pro forma for them and not looking at it on a year over year basis. Anytime you get into the micro and you lose picture of, you're looking at the tree and not the forest, you can make decisions that feel really good today from a tax perspective, but are building a big problem for you down the line. And so that's the first thing. The second thing would just helping them understand the impact of their pile of money or whatever assets it is that they have, and how they're actually taxed. It's blown my mind over the last handful of years as we've started to focus in on this tax thing, people's lack of understanding of the different types of accounts that they have, how they're taxed, how it's different, and how it actually hits their 1040.
Mm-hmm. Okay, so let's dive into the lifetime tax pro forma. I love that. I have a commercial real estate background. We're always underwriting, looking at in pro forma, and we do the same thing with our tax strategy as far as deferring capital gains tax. We're looking at the pros and the cons, the ROI. So break down that lifetime tax pro forma, and then also throw in one of the biggest maybe pitfalls that people they think they should do it, but you're like, actually, if you look at the forest from the trees, right, we would do it differently.
Well, obviously, this show, capital gains tax, is talking about one side of the tax code. A lot of the people that we deal with are living their life on both sides, right? They not only have capital gains that they need to be concerned with, or at least educated on, maybe not concerned. After they talk to us, hopefully they're not concerned anymore and they have a plan. But the ordinary income tax side, these people also have, retirement accounts, qualified accounts, as we call them, 401ks, IRAs, things of that nature. And so just looking at what they owe the IRS, where are you sitting on? So if you've got $1 million or $5 million sitting in deferred accounts, and you've got another 2 million sitting in a non-qualified account, or 15 million sitting in a non-qualified account, and understanding what cost basis is and what's sitting there, and getting an idea of what you owe the IRS as of today. And now that we know the playing field and basically the bill that you have, how can we mitigate that bill? Should we be stretching it out? Should we be pushing some of it forward, pushing some of it out? And some of that has to do with what they want with their pile of money. I mean, some people, when they look at their nest egg or kind of what their estate, if you will, it's all about them. They want that for themselves in their lifetime, and other people don't. Other people, that's all about their kids, or if we're just being honest, it's really about the grandkids these days. And how do we get it into their hands and build some sort of generational legacy? The advice is going to be completely different. That true north, as it were, and that long-term pro forma is going to be dependent on the client's response to, well, what do you want to do with your pile of money? And then based on that, we can kind of build out a plan from a tax perspective of how to get to the most efficient outcome as possible.
Perfect. That makes sense. Yeah. So what's the vision? What's the outcome? Like, I like to start with, like, why are you even selling the asset, right? Like, what are you trying to accomplish? What problem is that solving? What does that mean for your legacy with your wealth, your family, with your time, your energy, your stress, right? Yeah. And then what is this this amount of equity that you have now, what's it going to
Yep.
turn into in the future? So, what do you want to do with the pile of money? And then we're going to take in consideration qualified versus non-qualified, what you actually owe the IRS right now, right? And then of course, factoring ordinary income tax as well and what you're receiving. Is that a fair summary so far?
Yeah. Killing it.
Awesome. So then what's the next step? So we've established that we're basically taking an inventory where we're at, we're budgeting, we're doing the pro forma. What's the next step in the tax flow plan?
I want their opinion on where they think things are going. Because at the end of the day, I've got an opinion. Mine might be more educated than theirs, but it's still an opinion, right? And they have an opinion. And how they've gotten to wherever they're at today is based on a lot of opinions and thoughts that they've had throughout their life. And so we like to give them a lot of education around kind of how we've come to be in 2021 and why taxes kind of stand where they do today, and kind of a history of flow of taxation in this country and what that's looked like. Overlay that with data around, whether it's our debt or it's big events in economic history, whether that's a recession or a war or things of that nature, and get a general sense for them of where they think tax rates are going. Of course, we can give them our opinion, but at the end of the day, I need to know how they feel about taxes, because if we start building out a plan to kind of defer everything till later for them, but later results in a higher tax liability, because as you just mentioned at the top of the episode here, we have a bit of debt in this country. Now, the debt is all relative to one, inflation, and two, GDP, right? Because it's kind of this ratio of debt to income. But even when you overlay all of that, the highest debt to income this country ever had prior to present time was post World War II. 1946, we were at 108 cents of debt to every dollar of GDP. That record stood until last year. We broke it basically a year ago, last November. And since then, all we've done is spend and spend and spend. I'm not going to give you my opinion of the bills that are being passed and what they're spending it on. The bottom line is it's spent. And so now from a debt perspective, relative to GDP, it's to your point, they got to raise a lot of money. And I think they've shown their hand a little bit, right? The IRS, Congress rather, looks at capital gains taxes as a tax on the rich. They think that everybody that has capital gains taxes is rich. The narrative fits with where they want to raise money from. And so we can defer a lot of these capital gains taxes that you have. The question is, are we deferring a 15 or 20% rate? Not getting too fancy with things like net investment income in there, but are we deferring that into a 25% rate? Is it going to stay the same, and kind of how they feel about it? So long answer, but the bottom line is I want a general sense from them of where they think things are going.
Yeah, that makes sense. Their opinion makes, I always say our opinion means this much, but really it's your decision. You're the principal, right? And you make the decision, and I can give you the data, the information, you make the decision, and where they think things are going, if it's better to buy or to sell now, pay the tax, right? And or potentially defer it. So let's shift to the capital gains tax deferral, right? Because that's a kind of interesting part that you brought up there, and it's the name of the show, and that's what we focus on, and part of why we have like minimums, like our minimum deals, $1 million net proceed, $1 million gain, because the pain has to be big enough in order to pay for the fees and make sense of the ROI on our deferred sales trust, right?
Yeah.
And we typically see 30 to 50% of capital gains tax and depreciation recapture, depending on the asset and the state in which they live in, right? And if they depreciate it, how much do they appreciate it? And now Biden's proposing, and it looks like looks like at least they're taking off the table, the 1031, getting of that, seems like it, and taking off the stepped up basis elimination, which was crazy. We don't even need to go there because it looks like it's not even on the table. However, the 20% federal, it looks like it's going to be either 25, 26, or 28. And so I had clients call me all the time. They're like, well, it's going to be going up. I'm like, yeah, but you weren't going to pay it at 30. So you're probably not going to pay it at 35, 36, 38. Like at a certain point, it's big enough. The ROI makes sense, unless they need the money now for something like they want to spend it right now on their primary home or something that's like, personal, where it's going to become taxable. So just talk about the time value of money as a part of this pro forma in this scenario. What do you find the break even points, the ratios, perhaps even the equity to the tax versus the total equity on the sale?
Yeah.
Anything there that helps to give it some mathematical data?
Yeah. A couple of things I'll say to that. I mean, the deals that with your background that you're putting together, a lot of times you get into like a piece of real estate as an example. It's an all or nothing proposition. You can't sell a quarter of your house and kind of piecemeal the thing out, right? We deal more here at our firm with just investable assets and piles of money sitting in brokerage accounts. And so we can have that piecemeal transaction where it's like, look, we like the 15% rate. And so we're going to sell enough to take advantage of that and stop before we get to net investment income tax, or stopped before we get to the 20% rate. So we can have a little bit more control over how to take advantage of rates that we want to pay and not get into rates that we don't want to pay. Obviously it's less complex when I'm not dealing with recapture of depreciation, things of that nature. But, and I get what you're saying, but as far as like that long-term ROI or IRR, however you want to look at that, it's for us, it's looking at one, the purpose of the money matters. Okay. So if we're purposely going to pay the bill today, right, and reset basis on whatever pile of money that is, what is that money going to, now what are we doing with it? Right. I mean, the thing with, a pile of money that you now are sitting on from a cash perspective, what you choose to do with it in the future is going to determine if it made any sense to pay the tax bill or not. And for us, again, being primarily in investment accounts, at least at our firm level, it really comes down to the control, because you can't get tax control and financial control in a non-qualified account. I can't get active management and tax management at the same time, right? And so a lot of our decisions are coming down to, well, are you going to hold this for the rest of your life? Because to your point, they took this, and look, the ugly monster of getting rid of step up basis was originally in the first proposal. This new, more neutered version, it's not in there. But I do think Congress showed their hand, right? And so it doesn't, just because they're not playing that hand today and they're not getting the entire hand played on us, they're going to do something, right? I mean, at some point, a lot more taxes need to be paid to kind of stave off all this spending and the debt that we're creating. I mean, we can service it right now, and we've gotten away with it because we've monetized the debt here over the last, 18 months. And the printing press hasn't exactly killed us from an inflationary perspective yet. It's kind of, I mean, you're in California, you're feeling it more at the pump than we are here in Minnesota. But the bottom line is we got to figure out what we want to reinvest that money in. And if we are after investment control, because if I got a 65-year-old as an example, and we're having this conversation and they're in whatever investment, if you're going to hold it to 85, 90, 90 or the end of your life, then we don't really have a big conversation. Like there's not a lot to talk about, because as long as step up basis is there, leave the asset. It's hard to justify that sale. But if they ever think that they're going to replace that asset, physical or otherwise, then when's the best time to replace it? If we're getting into something similar, whether it's real estate or it's a brokerage portfolio or whatever it may be, maybe resetting the basis now at a 15 to 20% clip without bonus, without depreciation, recapture, and all that fancy stuff you guys have to deal with. That's a conversation to be had.
Yeah, no, I love it. I love that we're getting into the weeds a little bit here and we're getting detailed, because it's an important conversation to have. And the tax code has a lot going on, and you need professionals like Brad Gotto, who's going to help you create a tax flow plan so that you're not living reactively, but proactively, and you're going in this with the good plan, right? It's not just about cash flow; it's about tax flow. And I love the way you put that, Brad. The purpose of the money matters, right? And that's exactly right, right? If you're just planning on putting it and spending it and just consuming all of that, then perhaps just pay your tax, right? But if you're planning on just keeping it invested or going to another venture, if there's a way to tax defer it, and 100%. Again, if the deals are big enough, then that's different. So you got to figure out what the purpose of the money you're doing it for. And then to your point too, like there's certain people, like a lot of my clients, they're baby boomers, right? This is the largest wealth transfer in the history of the planet, right? Yep. There's 77 million baby boomers in the U.S. alone, 10,000 turning 65 every day. And there's like, trillions and trillions and trillions of dollars. It's never been a larger wealth transfer ever, right? Yep. And then 50% of all total net worth of America is tied to high-end commercial real estate, high-end primary homes, and private equity businesses, right? Yep. And that 50% is intense, right? Especially with increasing laws and regulations and hoops that people have to jump through to run their businesses or real estate. And they're ready to downsize from their house and move towards their grandkids, or move out of California, or retire from their business. And so they're like, I have the wealth. I don't want to wait till I die just to get the stepped up basis, if it's even around when the time that I actually die. And so now they feel stuck between a rock and a hard place, right? And this is part of what, and I'm curious what we're going to kind of dive into the deferred sales trust right now in a minute here, where we come in and we say, hey, look, sell it, defer the tax, invest it in a conservative portfolio of liquid investments, stocks, bonds, mutual funds. You don't have to go back into real estate if you don't want to. Now, is there ability to go should you want to? Yeah, there is. And we show them that. But the beauty of never having to feel that pressure between my stress and my time and my energy versus the tax is what we thrive on, because we want to provide that solution for them using the deferred sales trust. And we just, for example, we just did a house sale out of Palo Alto, and this gentleman wanted to move out of California, and he's selling an $8.3 million house. It doesn't qualify for a 1031. He can't roll it into an IRA, right? And he's like, if I don't have the deferred sales trust, I don't even sell. And so he goes through the whole due diligence for like a year. He was a super planner, CPA, all that stuff. And we did the deal and we closed it. We did another one in Colorado. We did another one in New Jersey for a dentist. We're doing cryptocurrency deals now too. We did a $5 million cryptocurrency sale for Bitcoin Ethereum seller. And everyone has different purposes for why they're selling. But at the end of the day, they didn't want to get hammered with the tax. So all that being said, any thoughts on anything I just said there?
Taxes are I mean, when you think about investments, in general, people, my industry will, champion the superior cause of diversification, right? And we'll tell you never to put all of your investments in one thing, right? If you've got an $8.3 million home, hopefully that's not the only thing that you have. Hopefully you've got other assets as well, and you didn't put all of your faith in one thing. Taxes are the exact same thing, in my opinion. Deferring every dime of tax you have in your life to later is a mistake. Paying every dime of taxes you can today is probably a mistake, right? Because at the end of the day, I don't know what Congress is going to do tomorrow any more than I know what's going to happen in the markets, or with whether it's real estate markets or stock markets or other crypto markets. I don't know. Again, we have educated guesses, but at the end of the day, the biggest mistake I see is the people that walk through our door that everything's in a deferral state or everything's in a paid state. And now they have no dry gunpowder to fire to react when Congress makes changes. Because if anything's consistent with Congress, it's change, right? They've been taxing us directly outside of just like excise taxes for 113 years. And over that 113-year history, if you look back over the taxes you and I have paid, the effective rates, the brackets, the loopholes, all the things, all it's done is change. And so in order to be positioned well for that, you got to be on both sides of the fence. You got to diversify. So tax diversification is probably not, maybe even a phrase people have heard before, but making sure that your life and your entire net worth has diversification in it is really important.
Very well said. I didn't put it that way before, and I think I'm going to try to capture this. The tax payment or the liability that you're deferring, right, versus just paying it up front. What you're saying, just like investing into, multiple asset classes and dollar cost averaging and doing these things that aren't going to put all your eggs in one basket, you should also not put all your tax liability and defer it all. Is that what you're saying?
Yeah.
All of it. You should do a little, maybe pay a little bit here and defer a little bit here. Is that what you're saying?
Yeah. I mean, when you look at somebody's 1040 at the end of the year, it's very rare, right? When you think about like marginal tax brackets or, capital gains tax brackets, or phase in or phase out of, credits that you could be getting, nobody ends right at the end of a bracket bucket or otherwise. Like a lot of times there's wiggle room kind of where they end up. They're in the middle of something. Mm-hmm. And so we could go backwards to get into the last bucket that we would like to be into, or we can say, hey, the bucket we're in is decent. I kind of like this. And so let's fill it up and take advantage of some of that. And so kind of year over year planning is really, really important for that kind of stuff. But that doesn't begin until you can kind of find that true north. And that's where we got to build out kind of that lifetime tax pro forma, figure out what your lifetime liability probably is going to look like. Of course, there's a lot of guesswork in that, just like there would be any financial planner trying to put, retirement income plan together for you, or a education plan for your kid that was just born that you want to pay for their college in 18 years. A lot of assumptions need to be made. But at the end of the day, it at least gives you a true north. I mean, you're in Sacramento, I'm in Minneapolis. If you said, Brad, I'm going to come see you, I'd be like, okay, head east and call me in about 22 hours. I'm not going to give you any details other than that. Just go east. And when you get closer, we'll dial it in. But we at least have to have a general direction to head. And that's where getting that long-term tax picture in play really, really matters.
Very well said. Thank you so much for sharing that. So now let's dive into the deferred sales trust a little bit. I'm curious, as a tax expert in a lot of ways, right? For what you're doing in the field that you're in. Like
Maybe a bit of a stretch, but I'll
yeah,
take
but
it.
yeah, for the fields that you're in, the people that you're serving for those areas, right? Because tax, yeah, it's like you got to pick like a niche and focus, right?
Yep.
But someone calls you, right, and they're like, "Hey, Brad, I got this cryptocurrency, man. I bought it for 100,000. It's worth $8 million. Doesn't qualify for a 1031 exchange. I didn't buy it in an IRA or a 401k.
Yep.
What's I want to defer it, Brad. I don't want to pay millions of dollars of tax. And they say, I heard about this deferred sales trust thing or this other strategy maybe that you offer or whatever. Like, walk us through how you're helping them make clear decisions on legality. Obviously a lot of this stuff, outcome, purpose of the matter, but assume like what would be your step-by-step process to help them through that?
Yeah, I mean, the beginning steps we've already discussed. It's sitting down and figuring out the outcomes that they want with that pile once all is said and done, and what that needs to look like. But for us, something like a deferred sales trust, quite frankly, Brett, we're going to employ strategic partners like yourself to make sure that from a legality standpoint and a detail standpoint that we're setting up the way that it needs to be. It's not something that we would do internally. This would be a situation where we're the general contractor and we subcontract out. I think that that's one of those areas where if you don't know 100% exactly what you're doing, you can really make some mistakes. And so I know what I don't know, and I know about the concept and I know where the concept fits. But the nuts and bolts of making that happen, we're going to reach out to the Bretts of the world and make that introduction and make that partnership.
Cool. Hopefully it's the bread of the world, right? With the deferred sales trust, everybody. CapitalGainsTaxers.com. Appreciate that.
Yeah.
That being said, are you ready for the lightning round, Brad?
I don't know what that is, but yeah, let's go.
All right. Knowing what you know now, if you go back to your 25-year-old self, what's the one golden nugget you make sure to tell yourself to do?
At 25, boy, probably be nicer to my wife. I don't know. I don't know if she's going to listen to this podcast. I don't know if I had to say that. No, but honestly, it would be I'm a spender by nature. Even as a financial advisor, my default setting is spending and putting more of my assets to work for me and paying myself first is probably the best advice I could give myself.
Right on. Awesome. Second question. What's the number one book you've recommended or gifted the most in the past year?
Atomic Habits.
Perfect.
The author escapes my mind because my memory is terrible, but Atomic Habits.
Fantastic. Question number 3. What are you most curious about right
now? Honestly, what's going to happen with taxes? We do a lot of end of year tax planning for our clients before the clock strikes midnight on December 31st. And, what the Senate's going to decide here is a big deal. So pretty curious about how that's all going to play out.
Absolutely. Second to last question. Number one leadership quote or theme that you strive to live by?
People don't save a pile of money to have a pile of money. They save it for a specific purpose or an outcome. And we just try to help them achieve that.
Fantastic. Last question. After all the people you've helped and with tax implication things, with financial, growing their wealth, your family, everything you've achieved, how do you stay centered in your values and how do you stay encouraged to charge forward to reach new heights?
Well, to be very frank, I'm a Jesus guy. I told you at the beginning, I went to school to be in ministry, and my faith is absolutely the thing that takes all the crazies I got in my head and brings me back to normal, or at least as normal as I can possibly get.
Beautiful. Love that. I am too. And likewise, like the world can be going wild, right? And all the things around me. But if I'm centered and I'm with the Lord and I'm connected with him, I'm at peace, right? Or the opposite. Everything could be going great. Everything's perfect out here. But if I'm not centered with the Lord, something's missing, right? Something's off. And so I love that you shared that part of your faith. I appreciate that. And I want to encourage you, Brad, to keep using the gifts and talents you've been given to be an educator, right? An educator, to be a leader, to communicate, to help people, to push people, right? To a point where they can get things done for their wealth, for their family, for their futures. And for our listeners who want to get in touch with you one last time, would you remind them where they can find you?
The easiest way to get a hold of us is our website. The website is www.fiat, F-I-A-T-W-M, stands for wealthmanagement.com, fiatwm.com. The name is all about faith and trust. It's not about the car. You can read about it on the website.
Or the crypto, right? Like so that's a whole nother episode that Brad and I could geek out on. But
Yeah,
thank
there
you,
you
Brad,
go.
for being on the show. And also want to thank our listeners for listening to another episode of the Capital Gains Tax Solutions podcast. As always, we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options, not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to grow your wealth, and or getting with Brad to do some tax and financial planning, getting your tax flow versus your cash flow. You got to do both, people. Make sure you got the right team of professionals to help you execute on what you're trying to achieve. Clarify the purpose of your money, because it really matters. If you want more help on how to defer capital gains tax, you can go to capitalgainstaxsolutions.com. You can search that on YouTube. We have our free mastermind every Friday, 10 a.m. Pacific Standard Time. CPAs, tax professionals, financial advisors, clients, everyone jumps on. People are looking at it for the first time. Go to capitalgainstaxsolutions.com to register for that free mastermind, 10 a.m. Pacific Standard Time every Friday. And we're also streaming on expertcresecrets.com. We don't want to forget those M&A advisors, business brokers, luxury realtors, commercial real estate agents that are listening to us. Thank you, thank you, thank you. Please rate, review, subscribe. That would mean the world to us. And we wish you a great, great rest of your day. Thanks, everybody, and goodbye.